Large Exposure Framework, RBI Guidelines. Large Exposure Framework, RBI guidelines aim to address credit risk concentration in non-banking financial companies, NBFCs, which are financial institutions that provide services similar to traditional banks but do not hold a banking license. These guidelines apply to a specific type of NBFC known as NBFC-UL, which stands for non-banking financial companies, urban cooperative banks, and apply to both the solo and consolidated, group, levels. The guidelines focus on identifying and managing large exposures, which refer to the sum of all exposure values of an NBFC-UL to a counterparty or group of connected counterparties. This defines large exposure as an exposure equal to or exceeding 10% of the NBFC-UL's eligible capital base, which refers to Tier 1 capital as defined in the Master Direction for NBFCs. To determine large exposures, the guidelines refine the criteria for grouping of connected counterparties. The guidelines also require NBFC-ULs to put in place reporting norms for large exposures and obtain an external auditor's certificate on completion of the augmentation of capital. In addition, the guidelines specify that entities economically dependent on an entity that falls within the scope of the sovereign exemption will not be deemed to constitute a group of connected counterparties. The guidelines also have specific provisions for NBFC-ULs held by non-operative financial holding companies, NOFHC. Overall, these guidelines provide a framework for NBFCs to manage credit risk concentration and ensure financial stability. By doing so, they help to reduce the risk of financial instability and systemic risk in the financial sector, which can have significant negative impacts on the economy and society as a whole. Thanks for watching.